All right, perfect. So I right here wanted to discuss the main points we went over this week. And the main points we went over, so the video titles were narrative, retracement, and resistance. Where what was the first thing? The first thing was narrative. Now, narrative was understanding, or first understanding actually, the bias. So where are we likely heading towards? Are we likely heading towards this low, for example, that we see right there? And when we are heading towards that low, then the narrative becomes important. Because if we are heading lower, then we are heading lower off of some kind of premium array. So can we find that premium array that we are actually heading lower from? That is the key point. And that will, of course, eventually lead into that premium array. That is where eventually we will look to take entries, etc. So it's quite important to understand which premium array we are likely heading lower from. Now, that is first seen through what we already went over actually in order flow itself in the bias week, because that's also seen a lot through order flow and having an order flow lag. So for example, if we take a look right here, we are going lower off of something in this lag if we do want to continue lower. And after that, we have a new Verweigerp lower. So we are going lower off of something in this lag lower right there. It is our job. And throughout this week, I mainly drilled down, I think I got my point across quite well, is that it's important to understand the resistance. Because the resistance essentially, like I write down here, I wrote down, resistance creates the retracement. So the retracement creates the narrative then. So it's not, we have an order flow lag and we can just select an order block right there or a fair value gap and we are definitely going lower off of that. No, it really depends overall how big the resistance is, how strong the resistance is, because we do not necessarily have a sting into this fair value gap right there to then continue lower off of that. If we did have that, then I would already expect this next candle to continue lower. But instead, we have a huge wick higher right there. Now, why does that happen? That happens because we have a lot of resistance. For some reason, we have a lot of resistance right there. Why do we have a lot of resistance? Because if we come below this discount rate, and that can be any PD rate in itself, and if we pay attention to, again, that sweep versus run, which is also a topic we're going to go over in depth later on as well, in a different educational video, then right here, we can already see that we do not necessarily create a fair value gap that's exactly overlapping with the low. So if we are potentially sweeping that, then right here, we would create a bullish fair value gap higher. So this up candle, that extremely aggressive up candle right there, that is a lot of resistance from what we can see. So we can then react to that because now we can understand, okay, the retracement might be a little bit bigger than we initially expect, where that I believe is so extremely crucial because if we want to work this eventually towards an actual strategy, if you just want to be an analyst forever, then that's perfectly fine, of course. Then this is all you need to know essentially. Then you don't need to worry about the resistance that might be coming up. But if we want to actually look at an entry pattern, which I believe 100% of us want to do, then it's crucial to understand how much confirmation we need for a certain entry pattern as well. Because we can't just simply take any type of entry at any type of PD rate, etc. Because there's a difference between when we have a lot of resistance versus when we don't have a lot of resistance. The entry patterns, the entry confirmations are going to be different as well. So it's about reading how much resistance we have. And resistance right there, like I mentioned, creates the retracement. The retracement creates the narrative. So it's not, again, it's not that order flow that necessarily creates a narrative. Yes, it's the first start. As in, that's the first sign we are going to continue lower from somewhere in that lag. But where are we going to continue lower from? That is what resistance actually determines. So that's very important to understand. So if anything, I wrote down, it's more about the resistance than it is about the narrative or where we are going lower from. So a flat, an odd, a lot is all nice and makes things a little bit easier. But if we do not understand the resistance, then all those things are just going to leave us a little bit clueless and like, where are we actually going to continue lower from? So the next thing right there is the conditions to trade in are crucial. Let price convince you. And what I mean by that is we went over this, especially in the video yesterday on Friday. And like I mentioned in that video as well, everything that we go over right here, it does not work if it's not in the right conditions. So It's always about finding the right conditions where this actually works in. And the reason why that again is so crucial is because everyone can find the narrative, everyone can find all the things we've gone over thus far, but it's more about the conditions than anything else right there. Which again, that retracement, how much resistance we have, is also part of those conditions, of course. So that again is quite crucial. Let price convince you, and the way I see this is always it's sort of like the market is trying to sell you something, and it truly is, because the market is always trying to either sell you a short ID, sell you something like a buy ID. So the market is trying to sell you something, and oftentimes people get convinced to buy something from the market when it's just one simple fair value gap or the conditions are not that great. Where I believe if you truly want to buy something very valuable from the market, it should convince you to its best abilities. And that is again those arguments that we talked about. So a bullish versus a bearish argument. Do we have any weird signs the price might do anything else than we are going to sign up for example? So good conditions I wrote down right there. Price really has no other reason to do anything else. That is good conditions where price can really only do one thing. And that leads again back to the arguments, where here, if we talk about this 4-hour value gap, at that moment in time, I remember mentioning, well, if this wants to be a sweep, then that's a perfect sign that this might be a sweep as well. So if we want to continue higher right here, then this is the perfect sign that this could be a sweep to continue higher. So right there, I already know if I now want to still see lower prices, I want a little bit more confirmation than dive into that 4-hour value gap to immediately look at lower prices right there. And that is exactly why I've written down the dollar example as well, because I want to go over a few different conditions. Now, if we take a look at the conditions that we see, for example, for this fair value gap right there. At that moment in time, we have this 4-hour value gap, which we can potentially continue lower from. We have the fair value area right there as well. And then what becomes the target? The target becomes this low sitting right there. Why that low? Because on the monthly, if we work our way down, on the monthly, we had this candle sign supporting idea of reaching that previous month's low right there. On the weekly, we were not respecting that weekly bullish value gap. This eventually, that previous month's low, becomes the target right there, which is a swing low on the daily time frame. Now, after we reach this low, then on the 4-hour, what we see is perfect price action, perfect conditions essentially. And what I mean by that is once we take that low, the ideal thing we want to see, the ideal scenario we want to see is that low exactly overlapping with a swing or with a fair value gap right there. So the swing low overlapping with a fair value gap. That's perfect in comparison to this example right there. And can you see those hands again? What we talked about throughout the week. Bullish hands, bearish hands right there. Then we have a lot of bearish hands right there and not a lot of bullish hands right there. So the resistance that we have because we are reaching into those discount rates are pushing price higher than just the fair value gap alone right there, a little bit higher. Where here, we don't necessarily have a lot of resistance. Why? Do we have a big up candle? Well, that's quite a big up candle. But the fact that we trade below that low and have an overlapping fair value gap after that leads me to think, okay, there's not a lot of resistance, because if it wanted to sweep, then ideally it should not even have a fair value gap overlapping with that low, like we saw right there. So that sweep, potential sweep below that low, does not mean that right there you would be bullish. But like I mentioned, you have a bullish person and a bearish person. And at that moment in time, the bearish person is winning the argument. But now the bullish person all of a sudden says something extremely intelligent and says something, oh, okay, that makes quite a lot of sense, right? So we need to take that into account, because then we need to become suspicious about what price action potentially wants to do. We're not too sure. We need to be that judge in the middle who's going to decide, okay, who's actually winning this argument? And after we get the nice rejection lower, we get extra confirmation. Now we can say, okay, it was just a false information and the bearish person is still winning the overall argument. That is how we want to view that right there. Where here, the bullish person really doesn't have anything to say. right there, because we don't really, good conditions, price really has no other reason to do anything else right there. It's not a potential sweep. It's clearly a run on liquidity right there. There's nothing really else to continue lower off of. It's perfect. Where narrative right there can be defined a little bit more, can be refined a little bit more. Because at this moment in time, I would refine where we want to continue lower off of towards only this fair value area right there and this area right there. Now, why is that again? If we look at this from two perspectives, we have in the market, we either do one of two things again. This is an extremely important topic, and that is why we're going to discuss this specific topic as well in a separate video. But I want to go over it a little bit more because we already touched on it a little bit as well. The market either seeks fair value or seeks liquidity. So it's either offering fair value to then continue lower, continue higher, just a move into an order block, mitigation block, fair value area, fair value gap to then continue higher or continue lower. Or it is seeking liquidity, so doing the opposite. Now, how is again fair value offered? Fair value is offered by essentially offering both buyers and sellers a fair chance to get involved. That's why it's fair value. So if we take a look at this right here, we have sell side right there. So sellers get a chance to get involved. But right there, it's not fair because buyers also need a fair chance to get involved, or they need to mitigate their position. They need to get a fair chance to buy something in the market. All right, perfect. Well, let's give them a fair chance right there. Now, once we create that swing low right there, which is also market structure, eventually what we are creating right there could also be an intermediate term low. Once we continue lower and we continue lower below that. So right there, we continue below that. That is exactly when we have now offered fair value. Now here, there's two options. Either we sweep this low, and that will be seen by something like this. And then instead of offering fair value, we will continue higher. Or what we do is right here, we offer fair value to then continue lower. So what right here is the fair value area? It is this right there, because that is where sellers and buyers both had a fair chance to get involved. So if we are offering fair value, then where's the only place that we have not offered fair value just yet? That is below that low, because that is where only sellers right now got a chance to get involved. So if we want to offer fair value, then the only real area that we can now come back and retrace back into is this area right there. That is sort of the maximum retracement line. If we do anything above that, that becomes again suspicious, because what if we do anything above that? Well, if we retrace back above that line right there, then we are not offering fair value anymore. So if we are not offering fair value anymore, we might be seeking liquidity in the form of the highs right there, where the last line of defense in that order flow leg actually becomes the target. So that's why I often mention, and that's what we went over a lot as well in this particular week. If we have the 2 candle rejection at a fair value area right there, and we have the last line of defense, which is a swing high right there at the top of the order flow leg, then this 2 candle rejection is actually the last line of defense before we will want to target that last line of defense and not necessarily want to trade off of it. So you can refine the area you are looking at of lower prices as well. It has very thin boundaries almost, where it's very specific of where we are going to continue lower off of if we understand this. And also, I would argue, there is now, we looked at it from a fair value standpoint and a liquidity standpoint. So if we are either offering fair value or we are seeking liquidity, we can also view this from simply said a sweep versus a run on liquidity. So if we are running liquidity, then we will likely offer fair value right there to continue lower. So that is also where if we are running liquidity, we will see again that fair value gap overlapping with that low to continue lower off of that, because that is characteristic of a run on liquidity. If we are sweeping liquidity, then what do we mention? Ideally, if we are sweeping liquidity in the form of those lows to then target the highs, then right there, we should, or well, again, this different variables, but first sign is that we do not have a fair value gap overlapping with the exact low sitting right there. So what can then happen is if we get a bigger retracement like this, even though it might seem like we are offering fair value at first, if we get a bigger retracement like this, then we are not offering fair value. We are actually sweeping this low. So that again becomes quite suspicious. And I'll show you a few examples as well here in the chart. Now, if we look at this price action, then the first price action we see is we have this move lower right there. I'm just very loosely picking those sell side, those buy side, etc. So here we have sell side. Then afterwards, we have this buy side right there. So this creates a fair value area right now. So if we want to continue lower at that moment in time, then we only have this fair value gap and that line of that fair value area right there. So this order block that we have right there, or even the mitigation block right there, anything else, this fair value gap right there, that I would not expect a retracement into that. If we retrace into that, that becomes suspicious, because then if we do something like this, I would argue that it becomes a sweep of liquidity potentially, because that is quite a big retracement, making this seem like a sweep right there to then potentially continue higher. So that again is quite important to understand, how you can be very refined with the area that we are going to continue lower, as long as we understand the market basics. So it's oftentimes, it's not some secret sauce, it's oftentimes the basics that make it so good. So right here, if we do want to continue lower, we have the 4-hour value gap. Now let's actually break down this last week that we had, because it's very similar, and that's why I also wanted to go over it right there. We start on the daily, and on the daily, if we take a look, we have this daily fair value gap, which we can continue lower from. Can we retrace back into that overlapping defense right there? Yes, because overall it is a fair value area, so we can retrace back into that. But that is definitely a little bit suspicious, because we have a lot of volatility continuing lower right there. There's not necessarily huge resistance that we are going against, so it's definitely a little bit suspicious in my eyes, making that big of a retracement. That is something we can dive into next week as well. How do we actually approach that? So right here, we had the first day, we had Monday sitting right there. And Monday already tried to reject lower. Monday didn't have news for an ID, so we introduced news as well a little bit right there. After that, we had news on Tuesday with a huge spike lower. Perfect. The next day can reach that previous day low and potentially that swing low right there as well. Absolutely perfect. So right here on the 4-hour, what do we see? On the 4-hour, we can then continue lower off of this 4-hour value gap right there if we do want to continue lower. Again, big resistance, right? We have somewhat of an overlapping defense, which is more clearly seen on the 1-hour. That's why I like to show the 1-hour right there. We have this big resistance right there. The first as well, trapped order flow part, where we will mess around a little bit before we actually want to continue lower right there. So that's why we're seeing that big retracement. And the big retracement is not necessarily a bad thing, but it is a bad thing if we now expect a 15-minute sharp turn, for example, the first 15-minute sharp turn like this, to then hold right there, to then continue lower off of that. And that will just translate into a lot of losses, where the thing you would want to see right here is just simply more confirmation. So what is that more confirmation? All things we're eventually going to dive into when we enter the execution month as well. I'm just sort of setting up. It's like a cross in football, in soccer for the Americans, and all you need to do is head it in. So I'm setting it up nicely right there for you to know how much confirmation you're going to need in the execution month. That's quite important to know. So right here, eventually we continue lower and we target that low quite nicely right there, the previous day low, which is a swing low on the 4-hour. This is where it all becomes very suspicious again, because now this looks like, to me, a potential sweep of liquidity. Does that mean that we are now going to definitely continue higher and we're going to target all the highs? No. Again, the argument statement, as in overall we have been bearish right there. So this is where the bullish person right now says one intelligent thing right there and mentions, this might be a sweep to continue higher. And that makes sense. That makes a lot of sense right there. So now it becomes very suspicious of what we actually want to do. So it becomes difficult as well. And the reason it becomes difficult, well, difficult as in if you are actually looking to trade this, it becomes difficult. Other than that, it's quite easy to just stay out of the market and wait a little bit. And the reason I mention it becomes difficult, because right now, if we make this retracement, the area that we might want to continue lower from, then this is going to even more support the idea of a sweep, because then we are moving even higher to then potentially continue lower off of that. So then this retracement becomes even more of a sweep than a run on liquidity. So it's doing actually the opposite of what we wanted it to do. So good conditions, price really has no other reason to do anything else. Here, price has a reason right now to continue higher. Price is giving a reason to continue higher and not only to continue lower anymore. So if you were looking to trade off of that 4-hour value gap, that order block, all right, that's not too bad idea. It's not too crazy, but require more confirmation. So more confirmation, even through candle signs, can be seen, for example, by first 2 candle rejection, afterwards just requiring an extra fair value gap lower on the same time frame, or requiring an extra down candle, an extra expansion phase to continue lower. More confirmation. That is, you can never do any harm with more confirmation. Now, eventually we're also going to dive into too much confirmation, of course, where you are staying out of profitable trade IDs. That's also a little bit not what we want, but we want to find that perfect balance right there. So this retracement in itself is already suspicious. Now, did we see this huge candle coming? I would lie to you if I said, oh yeah, I already knew that was coming. But we can again see and retrace those steps on why that happened right there, and how we can see that this setup on that 4-hour value gap to continue lower off that is just not really a good setup. So the resistance right there creates the retracement. But if the retracement is not really a retracement, but it's a sweep actually, then we have to pay attention to that as well right there, of course. That's very important. Now after that, we can just simply look to continue higher as well, and we can see the difference between that run on liquidity. And the reason I mentioned right here, can we now continue lower off of this overlapping defense? Well, that to me is quite suspicious. And the reason I mentioned that is because we are creating a lot of momentum, a lot of resistance coming into that overlapping defense. We are now, if we take a look at the weekly value gap, this third candle, very similar to overall examples that we went over on the 4-hour right there, is now creating a huge third candle higher, is now creating a very small fair value gap in comparison to the potential fair value gap it had as well. So right here, if we want to continue lower, I would want to see a little bit more confirmation than usual. So in the meantime, it's suspicious that we might actually want to continue higher. So let's see if we have some questions as well. Felt like I was the one trying to convince price this week. That's actually funny. I wrote that analogy down one time in a video, and that's exactly the analogy I used as well. As in, the market should convince you, but oftentimes people are trying to convince the market to do something, where they tell you, oh, but there's a fair value gap, so the market, you should do this. No, it's the other way around. Market, you show me on why you should continue lower. You show me on why I should now place a trade. It's not the other way around, which is oftentimes done. So yeah, it's very funny that you mentioned that. Can we make a judgment from the monthly candle in the making? Yes, for sure. And a little bit more advanced as well. But candle science essentially is also looking at how the current candle is forming, right? So if we make a judgment currently off of this candle, and let me delete a little bit of the lines right there. We're coming off that monthly fair value gap right there. The first target is this previous month's low. Now that previous month's low on the lower time frame, we already know, and that's for any previous candle high, previous candle low. It's a swing low or a swing high if it's previous candle high. So ideally we want to close below it, and the close below it is already seen early on by being comfortable below it. So spending a few days below that low, being again exploding below that low. Now we can see that by one singular candle, which is a little bit more difficult because then you have to incorporate time, etc. That's why we use the example right here of that daily value gap right there. But we can see that we are now potentially sweeping that previous month's low. Okay, that's a bit suspicious. So here for the next candle, what do we potentially want to do? Well, if this 2 candle rejection right there wants to fill, then next month we will look to target that previous month's high instead, and potentially even the swing high that we will create after this monthly candle close. So that is how we can view that monthly candle that is in the making. Exactly. Let's see. NQ had the same setup where I could have got involved on the retracement during the sell-off. Won't miss that again. Yeah, for sure, for sure. Where was that? On which day was that actually? NQ, let's see. Overall, it had quite some interesting moves right there, Nasdaq. Interesting move. Let's put it that way. Let's see. When price releases breakout traders like it did before on the 4-hour value gap on the 15th of February, does that completely invalidate any trade IDs for you, or would you just require more confirmation? Let me see. For the dollar, I imagine, right? For the dollar on the 4-hour fair value gap on the 15th of February. This is, which day is that? This one? Or wait, this one right there. Yeah, I remember this situation actually. I remember this situation right here. This situation. This one right there, where we trade back above it. So let's give some context for the people at home, I want to say, but everyone's home. I imagine. Now, right here. The way I see this and the way we can sort of refine where we also want to continue lower off of is oftentimes, again, seen through the basics. So what I mean by that is if we take a look at this scenario, then this swing high right there is where we have breakout traders. So it starts from the basic actually. If we talk about that offering fair value or seeking liquidity again, then this is a fair value area right there, which we can continue higher off of. So if we are offering fair value and we want to continue higher off that, then ideally those two rejections that we see right there is where we can already continue higher off of, because that's the fair value area. So any retracement below that, especially a fair value gap below that, is very suspicious that we might want to sweep that high instead to continue lower and target these lows right there. So right here, to give you an idea of what the liquidity actually is, why we are seeking that liquidity is we work with other traders in the market essentially. And when I say we, I'm not referring to us. We are not trapping traders. We don't have the liquidity to do that, but big institutions, central banks, they do. And they trap traders because they need that liquidity. They don't need our liquidity essentially because we are too small. Our liquidity, our lot sizes are too irrelevant. But other institutions that are less informed essentially on what is happening, etc., they get trapped. Now, what big institutions like to do is they like to be breakout traders. It's a very easy strategy. It's actually a very profitable strategy as well. To give you some context behind that, the reason why something is called a turtle soup is because there are turtle soup traders. And turtle soup traders, you might know the book actually. And the book is a trending strategy. And a trending strategy is usually the following. And I'm not sure, I read the book. I'm not too sure what it was. It's something with a simple EMA trading strategy, trend strategy. And they essentially trade like this. Now, what happens in a turtle soup? Whoop, and we continue higher. Who gets souped right there? Turtle soup traders. And that's exactly what the book called. Now, they made a lot of money as well. They have a lot of liquidity. They have huge lot sizes. So that strategy, similar strategies, trending strategies are still being used till this day. It's actually a funny little history story on why it's called turtle soups in the first place. But right here, if we look at those turtle soup traders, potentially breakout traders, buying above a high right there, because that shows the strength of a potential high if we trade above it, right? Then their stop loss will go below recent swing lows. So below the fair value area right there. They might target, who knows? They might also target 1 to 2, but usually they have even bigger targets as well, more so fundamental as well based. Now, right here, if we now want to suffocate and take that liquidity, so sweep that liquidity, suffocate their position. Why do we want to suffocate their position? Because if we first trade above it, they are now in their position. They might still be very bullish. It's going in their favor. Perfect. Now, all of a sudden, the closer price get towards their stop loss right there, so in drawdown, essentially right there, they also become suspicious. They also want to be like, I might want to mitigate this position. I want to get out of this position. But our job, again, when I say our, it's not actually ours, central banks, institutions, their job is to suffocate that position. Because if they don't suffocate that position right there, then they don't have opposing liquidity to actually get out of the market as well. So this buy right there is where they place their sell. is their liquidity to get involved in a sell position. Where this right there, where someone sells the position, they buy it back right there to get out of that position again. So the take profit is used by someone else's stop loss as well. So that is why we need to suffocate the position. So the question here was, when price releases breakout traders, and that's exactly what I mean, like it did before on the 4-hour value gap on the 15th of February, does that completely invalidate any trade IDs for you? Or would you just require more confirmation? So the way we see this, and this is also where we need to have a little bit of a lesson on Forex a little bit, and not necessarily very in depth, but Forex brokers are different, and wicks can be manipulated on Forex brokers. That's why you often see the wicks don't line up on certain brokers. So the wicks are often, or the way you can see it, is fake. So when people refer to the liquidity is above candles and that's the real liquidity, that is to some extent, that is definitely true. And the reason for that is because if a wick is not universally agreed upon in all brokers that are existent in the world, so they don't all have the same exact wick on that broker chart, then it's just a fake. And usually the candles are the most similar ones, because that is where the real liquidity is. That is where the most volume is in the market as well. So right here, if we see this wick, and then you can probably tell where I'm going with that story, then just because we wick above it right there does not necessarily mean that breakout traders at that moment in time got a chance to actually get out and mitigate the position. Then we would assume that they might be, well, obviously they're not demo traders, because then they would not be targeted. Then we would assume that they have such a good broker that they could get out at that moment in time, that they have the exact broker as us. So if it's just a wick like that, then for me, that is not necessarily enough to say, all right, we are now comfortable above that high. And when I say comfortable above that high, let's say right there, we did it, we had that wick, and afterwards we trade back up into that, and we now start to see body closures above that. We start to see another few wicks right there. That's when I say we are comfortable above that high. And when we are comfortable above a high, we are not in that urgent rush to trap someone to suffocate their position. And that's exactly what we want to do when we want to seek liquidity and we want to sweep liquidity. So for example, this right here. At this moment in time, this could also, I would argue that this might be a sweep at that moment in time to continue higher, to return back into the range. But once we then return like this, and then we have a new sort of sharp turn like that, we were already comfortable above below that low right there with that new sharp turn. So that second sharp turn right there, this is like, it's like, all right, you're not fooling us anymore because you're already comfortable below that low. So breakout traders were already potentially trapped right there. They just got a chance right there to even hold their position or even get out of the market at that moment in time. So we are getting comfortable below that low. Where this again is still not comfortable above that high. And again, the whole story behind that wick is important to understand. So do I need confirmation at that moment in time? You could require a little bit more confirmation. I could definitely see why. But understanding that, I would still want to see just a normal confirmation. So does not invalidate it completely, just purely based on that wick, if that makes sense. We'll go over a few more examples as well to drill that in. But if we wait for 2 candle confirmation, then the chance could already be gone. Yeah, that's exactly, I believe you're referring to the dollar as well when I mentioned ideally we want to have a little bit more confirmation. And that is very true, of course. Confirmation and the setup could already be gone. Now, the thing with that, I wanted to mention that in a previous video as well, is that's a good point. That's a very good point. But I would rather have more confirmation and be certain about a certain setup than having less confirmation and then taking a loss and eventually adding up like, should I have taken that trade, etc. So I would always require more confirmation and I'm happy if I then miss out on a trade. The key is there, of course, is not requiring an unbelievable amount of confirmation where it almost reaches the low, etc., and where we don't even have a chance to get involved. But oftentimes, people undermine, I would argue, how much confirmation they can acquire or require from the market. So what I mean by that is, if we want to see lower prices, and this is what we went over a little bit in the resistance video as well, which eventually will come back in the execution month. if we want to see lower prices, we can essentially wait until the last moment before we actually reach this low right there. Now, why that low? All things we're also going to go over still. But in here, there is resistance that we are essentially running against right there. All we have to do is wait until we actually get a new fair value gap lower, for example, like we mentioned in the resistance video, to then the last moment to then get involved right there. So in the worst case scenario, we get involved in the last moment right there to then trade it. So that is even a higher probability because we are quite certain that it actually wants to continue lower. So that's finding the balance again, if that makes sense. Hopefully that answered the question as well a little bit. Exactly. Perfect. Waiting for a new fair value gap lower. Perfect. Let's see. The dollar monthly looks like old bank nifty weekly low. Yes, the dollar. Yeah, it does a little bit. It definitely does. See, I was referencing NQ Friday sell-off, and then it retraces into the breaker for re-entry. Let's see. Yeah, Nasdaq right here. It was a bit tricky to be honest. At least it's just the price action was all these consolidations, those small little consolidations, at least in my opinion, made it a little bit more difficult to navigate price action as well. Right there. Yeah, the big sell-off indeed. Interesting. I just wanted to ask about new supporting trade IDs. Does news have to be there for that specific day, or if the previous day candle was a rejection with news supporting that day, would you take trade the next day even though there's no news for that day? I hope this makes sense. That does make sense, and that is under specific conditions. So I'll tell you which ones. That is for JPY, Australian dollar, New Zealand dollar, usually the case. And why that is the case is because when we have Australian dollar news, New Zealand dollar news, JPY news, it's usually very late during that specific day. So what that then turns into is you have volatility for that day, but also the next day. If we're talking about the US dollar, I would always want to have news on the same day. So US dollar referral news on the same day, unless it is NFP, CPI, or FOMC. Where NFP itself, not necessarily, more so FOMC and CPI, because then the next day is also still very volatile. So especially FOMC is during it's 2 p.m. What is it? 2 p.m. I believe. I want to say 8 p.m. but that's Amsterdam time. 8 p.m. Amsterdam time. And that is when we still see that FOMC volatility as well throughout the next day. So even if we don't have US dollar red folder news that next day after an FOMC day, it's perfectly fine because we had FOMC, if that makes sense. So under those conditions, yes, it is fine. But as a general rule of thumb, if it's just a normal week, as in you have unemployment claims on Thursday and Friday, you have no news, then Friday I wouldn't want to trade. And actually a good example of this is GBJPY. Let's see. Right here. So GBJPY in itself, it delivered towards the target that we had. And I mentioned after, what is it? Wednesday or Tuesday, I believe Tuesday or Wednesday, I'm not too certain actually, that we didn't have news supporting the ID anymore. So when we don't have news supporting the ID, we can still get to the drawn liquidity. That's not really the problem. But the way we get there is the problem. So for example here, can you imagine how many potential losses we would have taken right there before we actually get the right move? Before we see, okay, well, that right there is the real move before we want to continue higher. So that is the tricky part. That is why ideally we want to have news supporting ID. ES was super accurate on 50 minutes at 8:30 yesterday. Someone mentioned time was not agreeing there. Can you go over there real quick? Yeah, I saw it as well. And I think it's debatable because in the past, I've also mentioned if we have 8:30 news can already be volatile enough that 9:30 will just follow through. And that's the same like we've always mentioned, which in recent enrollments I've not really mentioned, but previous enrollments, the 5 enrollments before that, that are still on the previous website on WAP actually, we mentioned if Asia already expands, then London is just a continuation of that. And that's the same thought process here on the indices. If 8:30 already expands, then 9:30 is just a continuation of that most of the time. So if 8:30, and why does it expand? Because it already has news supporting the idea at 8:30. If it then leaves behind fair value gaps already, those fair value gaps can definitely already be traded off of to then continue lower. So in this case, can we say time is not agreeing? Well, I would argue time is somewhat agreeing right here. Now, before that, at 8 a.m., it becomes a little bit of a different story, where that is definitely quite early. But we see right there at 8:30, we already sting into that. And I imagine we had some confirmation as well right there to then just already continue lower off of that. And that is simply because we already have the volatility. We already have news actually at that moment in time, where I believe we had 8:30 news on Thursday, on Friday, sorry, and also on Thursday right there. And that's why we're seeing those moves a little bit earlier right there as well, where essentially you would want to avoid the AM session. And the reason for that is because if we do get that early volatility and 9:30 actually reaches those lows, the 9:30 at the beginning will usually just have somewhat of a consolidation before it actually tends to move as well. So I do believe there's an argument to be made. It was super accurate, yeah, and I do believe there is an argument to be made. The time was already agreeing with the idea. It's actually something we have not gone over in quite some time, and I do feel like that might be actually a good reminder as well, especially after price action like this. Let's see. So if we have a 1 hour value gap coming into a boundary and a 15 minutes value gap coming out of it, would you wait for another 15 minutes value gap to form above the 1 hour value gap in order to enter? That really depends on the overall scenario. General rule of thumb, I would argue the 15 minutes value gap itself is already enough. But then what we talked about, the resistance, etc., which creates the retracement, that really goes into that. As in, if we just have, for example, if this was a 1 hour value gap right there, and we could continue lower off that, and we have a situation like this, then as general rule of thumb, if everything is aligning right there and we don't have clear rejection lower where it might indicate that we want to continue higher, then I would say perfect, we can already take that entry right there. Do you think it was a good trade idea to get involved on ES after 5 minutes for value gaps after rejecting the 1 hour nested order blocks? Right here, after this one, this higher one. Let's see, which one was it? Because here, for me, this 15 minutes for value gap itself, it's just the thing that I don't like is that 15 minutes for value gap is created before anything significant. Meaning there was no news, I believe, correct me if I'm wrong, there was no news before that. And we also had no equities open just yet. So then that would lead me to wait. All right, well, if we do want to continue lower, then an extra confirmation for 5 minutes for value gap, 1 minute ST plus read, something like that, to then continue lower off that. I find that with rapid expansion, if you can identify the potential drawn liquidity, then easier to take the entry. Yeah, for sure. 100%. If we just, I believe it's very similar to overall price action we had earlier as well. This one, for example, right here, where we expand lower, which also leads to drawn liquidity is quite obvious at that moment in time, where we just want to continue lower. So any fair value gap that we might trade back into right there, it leads back to, and it's very funny that you mentioned that actually before I start to rant right there, but that is again what we have touched on this week a lot. As in, if we have a lot of resistance, that makes it a lot more difficult to get involved as well, because here you could only require a 1 minute sharp turn and it will likely hold because there's just so much bearish momentum where the retracement is almost a coincidence. You don't expect it, and then once we had the retracement, oh, perfect, we can get involved right there, and it just explodes. It's like a free ticket. It's almost like a free ticket. It's just lucky right there if we do have a retracement and we can still get involved. And that's exactly because there's just a lot of bearish hands pushing that lower. There's a lot of bearish momentum. There's not necessarily a lot of balance. There's nothing bullish pushing price higher right there. And that's exactly in situations like this where we need less confirmation overall because we are expanding so rapidly. That's a good point. I like that. Let me know if that makes sense, by the way, Latvisk. The 15 minutes for value gap was not enough here, right? Yeah, it was. I personally would want to see a little bit more confirmation, but just purely as well because of time. Relative equal lows on Nasdaq helped me take a short after 9:30. Yeah, perfect. I like that a lot as well. If we take a look, eventually those lows, yeah, the quite obvious target after that as well. And then right there, deliver quite nicely. Let's see. So it's like DAX get a fair value gap after opening is higher probability than before. Exactly. yeah, it's very similar to DAX. They all sort of correlate in that as well, depending on how much volatility there is coming into it. Because if there's a lot of volatility coming into a certain market, then fair value gaps itself might get swept before we actually make a significant move. But on DAX as well, if you already have a really significant move that can sort of the same volatility amount that is about to come into the market, then that fair value gap is already really good to trade off of as well. Really depends on the overall. DAX is a little bit more difficult, I would argue, because DAX 3 AM is just that crazy volatility. But as a general rule of thumb, right there, if we already have 8:30 news, etc., then the trade ID can already be there for sure. And especially, by the way, if you're not looking at the 1 minute time frame and you're looking at 5 minutes, 15 minute entries, then covering that high and an entry before equities open, that's doable, 100%. See, the resistance lesson opened a whole new world for me. Love that. Love that. Yeah, I think it's definitely a very important topic. And I think in previous enrollments, I did not emphasize too much on it, but I think that is purely the resistance is arguably what leads to the most losses, where a lot of people can understand where it wants to continue lower, continue higher from. I don't necessarily think that's the difficult part, but I think the resistance, if you truly want to filter out a lot of losses, then resistance and understanding that story is so incredibly important. It saves so much losses. So much losses. All right. Let's see. I've watched it 4 times already. I love that. I love that. All right. I am going to end it here, team. Wish everyone a great weekend as well. Monday, we dive into, I want to go over some extra bias tools as well that we are going to use, because I feel like bias overall have not gone too in depth on that. For example, the offering fair value versus sweeping on liquidity, etc. All those things, they match with week 1 and week 2. After that, we will move on to context, which will be extremely interesting because that is where we are going to dive into entries as well. So that's just before we dive into entries. Thank you, team. Thank you, everyone, for being here. Have a great weekend, and then I'll see everyone at the next one. All right, perfect.